My name is Matt Dober and I'm a lawyer with Business Law Group in Kelowna. I'm shooting this video today from our downtown office on the corner of Ellis and Lawrence. I'd like to address one of the more commonly asked questions of our firm by our clients, and that's namely whether they should be incorporating their businesses. Clients are often of the mistaken belief that it's not necessary or desirable to incorporate their businesses until the business has proven successful. And although this may be true in limited circumstances, the decision to incorporate should not be based upon the business success or the business's profit level. Most businesses, whether they be small or large or new or established, face some degree of financial risk. And while there are a number of good reasons to incorporate, the most important reason to incorporate a business is to separate the financial risk of the business from your personal life and your personal assets. A corporation is treated as a separate legal person from its owners. I often think of incorporating a company as giving birth to a new person, but that this person is alive solely for the purposes of carrying on business. In many respects, a corporation has the same legal status as a natural person. For example, a corporation can sue and be sued, it can borrow and lend money, it can enter into contracts in its own name, and it can become accountable for taxes. Unlike sole proprietorships and partnerships, the owners of a company are not liable for the actions of the business. And in this respect, a corporation is often referred to as a limited company, in that the liability for its owners is limited. A properly incorporated business can be a highly effective tool for protecting a business owner's interests. Another good reason for incorporating your business is the flexibility of shared ownership. So, unlike other forms of business organizations, the ownership of a corporation is evidenced by shares. The Business Corporations Act provides for a very comprehensive framework within which shares of a corporation can be issued. It provides for the issuance, the sale, and the repurchase of shares of the corporation. And this framework provides owners with a great deal of flexibility in sharing ownership with multiple parties, or in raising capital, or in changing the structure of a business over time. There are also a number of important tax considerations to consider when incorporating a company. Among the advantages are the ability to split income with family members, the ability to defer income over time, and the ability to take advantage of what's known as the lifetime capital gains exemption if the business is sold for a profit at some time in the future. Income splitting is a basic tax planning strategy that aims to split income earned from a corporation with more than one party in an effort to reduce the overall tax burden of the group of individuals. At the time that a corporation is incorporated, a family member may purchase shares in the corporation for a nominal value. The shareholders of the corporation, being the family members, are then entitled to share in the profits of the corporation without actually having to contribute to the business. And this is a very unique situation with corporations. In the case of a sole proprietorship or a partnership, individuals who are receiving income from the business generally have to provide some form of services to those businesses. A corporation can also be used by a business owner to defer the payment of personal taxes if the business owner does not immediately need the cash from the company. So unlike other forms of business organizations, the income from a corporation is taxed in the hands of the corporation and not in the hands of the owners until that income is actually distributed. So owners of a corporation don't pay any personal income tax until those profits are distributed. And although the corporation must pay tax on its income in the year that it's earned, the owners can defer payments of profits from the corporation, allowing them to defer the income tax payable on those profits until the time that they actually need to make use of the cash personally. Owners of business corporations may also receive tax savings at the time that they sell a business. and this tax savings may not be available for other forms of business organizations. This concept is generally known as a lifetime capital gains exemption. And the basic mechanics of the lifetime capital gains exemption allow the owner of shares in a business corporation to sell those shares and to be exempt from any gain that might have been realized on those shares over time. And again, this is a tax advantage that is strictly reserved for shares in a small business corporation. So individuals who are starting new businesses are often reluctant to incorporate their businesses because of the additional costs at startup and the additional maintenance costs. But I think some of the benefits that I've explained in this video show that the long-term benefits will quickly make up for the additional costs. Our firm is pleased to offer fixed fees for the incorporation of a business and for the annual corporate business that must be performed. So I would really encourage you to visit our website for a summary of those fees. Although a business corporation is the most common and sophisticated form of business organization, it may not be right for everybody. So I would encourage you to contact our office to set up an appointment if you're contemplating incorporating your business and would like more information.